or I'm saying bullshit or whatever, or you just want to ask questions, please just interrupt me and ask me the question or tell me what you want to say, okay? Remember, the only reason I'm here is you. I mean, I'm supposed to be at your service, not just, you know, telling weird things to please me. So the lecture is supposed to be for you, hence, in case it's not what happens, just tell me. Do you still have the same problem with the, which is that basically I don't understand what's happening with this. So what happens if I click there? Seems to be better, but well, for weird reason, you know, it's working with bank, it's working with statistics, but I don't know why it's not working with insurance. Maybe someone knows. Maybe I should buy an insurance so that my computer works. But something doesn't work properly. So we'll do the same as last week, that is to say, with the largest possible image. But I can go full screen. Well, whatever. Last week, you know what's happening there? Oh my God, not this. No. So last week, we've been going through the an introduction featuring a definition of insurance. What happened is, well, some insights about the antiquity of insurance, then about the morality of insurance, then about the mutuality principle, and then I've been saying to you that the inverted cycle in the insurance business commands a very peculiar form of balance sheet for insurance companies. I still try to get rid of the notes. That's it. But the balance sheet I've shown you was, you know, shameful because it dates back to 2011. So maybe we do it in a more contemporaneous way. So if you look at the current aggregate balance sheet of Eurozone Insurance Corporation for 2020, then first, the total asset of insurance corporations in the Eurozone is 8.7 trillion euros, which is quite a lot, of course. And when you look at what's in the asset, then above all, there are securities and loans. Because securities and loans together, if you look in percentage, they represent more than 80% of the total asset side, with currency, I mean cash, for immediate expenses, being 5% more. So there are not much other assets than, you know, financial assets, basically. Okay, the other kinds of assets are non-financial assets. In the past, insurance corporation had some housing and other real estate, but today, for regulatory reasons, it's no longer fashionable and no longer trendy. In fact, it's too costly for insurance corporation to hold real estate assets. We'll see when we talk about regulation, but basically there are capital requirements when you hold assets whose value can change with, for instance, the economic cycle. Then when we look at the liability side, of course, the two largest blocks are equity on the one side, I mean regulatory capital, and reserves. And reserves, in the case of insurance, are in fact mathematical provisions, which are supposed to be more or less the mathematical expectation of the claims or the losses that should be paid as a result of contracts. So, at a given moment, insurance provisions or insurance reserves are the mathematical expectation of what is supposed to be paid to the policyholders. When we say the mathematical expectation, we take into account, of course, discount of future amounts. That is to say, maybe in the end, the insurance will have to pay more than the reserves, because, as you probably know, when we talk about future sums, there is a discount. But basically, an insurance company is a large amount of reserves, some own funds or equity, okay, and then this is for the liability side, and then on the asset side, many assets, mainly financial assets, which in fact incorporate or store the value that has been paid by policyholders. Basically, when you pay an insurance premium, the insurance company puts some asset on the asset side, which secures the future value of your claim, and write your claim as mathematical expectation on the liability side as a provision, and then only a small share is used as a store of cash, okay, immediate reserve, and only a small part of this premium is used for paying for expenses of the company. Okay, so now that we have and this is all due to the peculiar form of the inverted product cycle of the insurance, where first you take the money and then you deliver the service, and sometimes it takes years, if not decades, if not centuries, no, maybe not centuries. But for instance, if you look at in America, or especially in America, for instance, the asbestos producing companies were insured. Asbestos, c'est l'amiante. Okay? So when the companies that produced asbestos started to experience claims, filings against them, complaints, either from their customers or from their own employees, it happened sometimes more than 3 decades after the insurance premium has been paid. So sometimes it takes a very long time for the claim and the loss to materialize. Okay? So, so for this reason, okay, the insurance company stores the value which is paid in premium, expecting to pay back some claims. Okay. Hence, the balance sheet is maybe quite huge in comparison with the annual turnover, annual sales. Okay, now, and this will be maybe not the end of the introduction, but the next step, maybe we could think of what an insurable risk is. We'll do this in 2 times. First, from a theoretical point of view, we'll review what are supposedly the assumptions, the assumptions which relate to a risk being insurable. And then we'll see with some examples why it's not that obvious. Because those assumptions are more or less assumptions in the logical or mathematical sense. And they do not exist in reality, so you have to assume them. Okay, so when you look for the definition of an insurable risk in anything, from Wikipedia to to an insurance handbook or manual, you will see that in order to insure a risk, you're supposed to have a large number of homogeneous units. And sometimes authors relate this to the law of large numbers, albeit the law of large numbers is dubious, as we will see. Then we assume independence among the units exposed to risk. We'll do some comment. By independence, I mean statistical independence. Okay. Then we assume that losses are identifiable and calculable in monetary terms. I mean, it's not psychological loss. It's not something which you cannot make sense of. For instance, you cannot sell insurance against the invasion from Mars simply because invasion from Mars has no practical meaning in terms of calculating the loss which has to be indemnified. Then loss should be random. That is to say, the policyholder cannot trigger the losses. So, in other words, there is no moral hazard. Because, of course, if you insure people against risk and the risk is themselves, then you cannot earn money. You cannot make this profitable. Okay? Then we assume that there is no anti-selection, no adverse selection, sorry. Anti-selection is grossly French. No adverse selection simply because that is to say that selection is not perverted. When you raise the insurance premium, of course, you're supposed to attract worse risk, but this works. Okay, so you can correctly select between risk and proportionate the insurance premium to the amount of risk which is taken or which is borne by the policyholder, the customer, the prospect. Then there's an actual business model. This may not make sense, but or this may seem too simple. But for instance, take the natural catastrophe in Japan. Well, usually there is no business model for natural catastrophe because they happen too rarely. They are too concentrated. That is to say, the loss is too large to pay for. Or shall I say, the premium should be too high for the insurance to be interesting. But for instance, in France, we built a natural catastrophe insurance scheme which is linked to insurance. And this somewhat does work because natural catastrophes are not too frequent. In Japan, for instance, nobody would think of setting up an insurance scheme for natural catastrophes, simply because natural catastrophes happen all the time. Hence, people first try to avoid the zones which are most exposed, and then they better save than try to indemnify. That is to say, there is no business model for natural catastrophe in Japan simply because the premium would be too high, and people would think it's uneconomical. They'd rather select the places where they build and where they live on the one hand, and on the other hand, save. Okay. Then, in order to insure a risk, of course, that risk, the behavior which is linked to the risk should be legal. It seems quite difficult to insure yourself against criminal prosecution. Okay. To pay for an insurer to remove you from a country when you're supposed to have legal problems. Of course, this would be completely illegal. And, well, in this respect, there is some discussion about this concept because, well, for instance, there is a huge controversy in Saudi Arabia whether car insurance should or not indemnify drunken drivers. Because, not just because being drunk is illegal in Saudi Arabia. I mean, it is in France as well. You're not supposed to drink and drive. I mean, not at the same time or not in overlapping moments. But in Saudi Arabia, people take this from a religious point of view. I'm not saying anybody because in the end, car insurance does take, car insurance does pay for the losses which occurred from people driving when they are drunk. Of course, once car insurance has paid, then the car insurance sues the guy who was drunk. And of course, the guy who was drunk, he will probably get into trouble with criminal justice of Saudi Arabia. So I mean, as you can say in the case of legality, you can to some extent distinguish between illegal actions and paying for losses which are the consequences of illegal action. But to some extent, insurance is not supposed to incentivize illegal actions. Hence, the controversy in Saudi Arabia. But for instance, there is more or less the same controversy in France about insuring the liability of board members in public listed companies. That is why is there such a controversy? Because of course board members, they take the important decision in a company's life. Hence, when a company is sued for a governance reason, because for instance, think of an oil company and a tanker which was chartered by the oil company, the freighter had a problem, not freighter, a tanker had a problem, and then it led to an oil spill. Hence, the environmental association and maybe the state where the oil spill happened sues the company. Not the company only as a legal person, but also the board members of the company as private persons to say they are liable, they are responsible for what happened. So some insurance company, they are offering an insurance against that kind of prosecution, while some countries believe this is illegal because it makes easier for board members to take irresponsible decision. I mean, since they are no longer liable to the financial consequences of their acts, then it somewhat encourages moral hazard. So for this reason, there is a huge controversy about whether it's legal or not to insure the liability of board members. Some say it's legal to insure the civil responsibility, I mean the losses which are not the result of a crime, while it would be illegal to insure, of course, the criminal responsibility, the penal responsibility. Okay. Then, in order to insure a risk, the insurer should not take the risk of getting ruined, because, of course, if the insurer goes bankrupt, he could no longer pay for the losses. He could no longer pay the claims. So, actually, a risk which would make the insurer broke or bankrupt would not be insured. Of course, the contract would have been signed, but the claims could not be paid. This usually happens in case of very, very large risks, where the insurer could not charge the entirety of the amount to be claimed or to be lost on a single year. Okay. So for this reason, catastrophic risks are usually not amenable to insurance, not standard insurance. Okay? That is to say, if the state, for instance, makes it compulsory for people to insure, then it could work. Or if the state sets up an equity fund or a buffer insurance company, such as where, for instance, in the case of natural catastrophes in France, we have that Caisse Centrale de Réassurance, which is a public reinsurer, which acts as a guarantee for those who sell some insurance contract, which could lead to the risk of bankruptcy. But in this case, the risk of bankruptcy is taken by the state via the Caisse Centrale de Réassurance. That is to say, in order to insure very large risk, since there is a potential risk of ruin for the insurers, the state may set up some fund which makes it possible for the insurer not to go bankrupt so that the risk becomes insurable. And then there should be no disproportionate risk. What do we mean by this? Oh, in fact, this is probably not a usual assumption of risk insurability. But you will see that quickly that it makes sense in a specific context. Basically, the idea is that, well, basically this is a substitute for a large number of homogeneous units. So let's save it for a bit later. Okay, so when we look at those assumptions, especially large number of homogeneous units, independence among units exposed to risk, losses are identifiable, and moreover, but when I say identifiable and calculable, I mean they are not infinite, okay? And losses are random. This looks very much like the assumptions of the central limit theorem. Because if you remember the central limit theorem, basically the assumption are you have a random sample. By random sample, I mean random variable with same distribution and independent random variable with same distribution. And expectation and variance are finite. So when you have those four assumptions, that is independent random variable, same distribution, finite expectation, finite variance, then the limiting distribution is the standard of what? Of the mean of those variables minus their expectation divided by the standard error divided by square root the number of variables. Then this converge toward the standard normal distribution, okay? So why do I say that it looks like the central limit theorem? Simply because, look, large number of homogeneous units. Homogeneous means same distribution. Des variables aléatoires de même loi. Then independence means not just homogeneous same distribution, but also independent. Together, same distribution and independent means random sample. Then, identifiable, calculable losses means finite expectation, and finite variance. And then, of course, randomness means we're talking about random variables and not just people doing whatever they like. So basically, the four first assumptions, they break down to the classic central limit theorem. By classic, I mean it requires the assumption of same distribution of random variables. And of course, this is not at all realistic in an insurance context, because you cannot expect every insured to have every policyholder to have the same distribution of losses. Of course, when you sell car insurance, for instance, some drive better and some do not. And, well, there is a very simple difference which the European Court of Justice say not to exist, or at least not to be relevant from an insurance point of view. But for instance, women do have more trouble with car insurance, but the overall value of all those problems is far less than the overall value of crashes caused by men. Because men crash very rarely with car insurance, but when they do, the loss is far larger. So overall, there is a gender difference between, men and women as to what regard the distribution of losses. But, of course, motor insurance is an insurable risk. And so the point is not to look for same distribution, but maybe for distribution that can go together toward normality. And for this reason, we have a stronger central limit theorem. By stronger, I mean the assumptions are weaker. So you, so far, are familiar with the classic central limit theorem, which was, proved by Laplace. But in the 1920s, a Swedish guy whose name was Lindeberg proved that instead of having random variables which have the same distribution, are independent, and have finite expectation and variance, we'll be satisfied if only we have random variable satisfying the Lindeberg condition. And the Lindeberg condition will appear on the next page. Okay? Because if we have random variable, independent random variable satisfying the Lindeberg condition, then the same, which is the sum of those variables minus their expectation divided by the variances, the standard error, the sum of the standard errors of those variables, because of course, since they do not have the same expectation, they do not have the same, not necessarily have the same standard error as well. So this is more realistic because it can take into account difference in random variable sums, and of course you figure that every random variable is an insurance contract or a policyholder, okay? And you can have as many different random variables as you want, as long as this condition holds. And basically this condition means that, well, shall I say it simply, large deviations from the mean have zero probability or have a negligible probability. Okay? That is to say, this is what is stated when you see in the accolade. In the accolade, it is stated that the distance xi minus mu I above epsilon, okay, and that is to say that this is a large distance between the actual value of the variable xi and the expectation mu I. So the Lindeberg condition is simply that you can add together random variables with finite means and variance, which do not have the same distribution, as long as first they are independent, but also they are such that you're not summing variables with very large deviation with variables with very small deviation. If you add together variables with very large deviation, as long as you have enough of them, and as long as very large doesn't mean infinite. Okay, so if the order of magnitude of the deviation is the same for all variables, it works, as long as you do have enough variables. But if you, basically the idea is the same as when you're trying to add together, grains of sand. You can pile up sand as long as every piece of sand has the same size. But you cannot play with sand if the sand features bowling balls, supertankers, and real sand. To talk about sand, you must think that every piece of sand has more or less the same size. So basically, it's the same idea here. The random variables must be of the same magnitude, not in terms of expectation, but in terms of variance. So maybe we'll change a little that the assumption for an insurable risk if we switch from the Laplace central limit theorem to the Lindeberg central limit theorem, because we would replace large number of homogeneous units by large number of units of the same order of magnitude in terms of variance. So we replace condition assumption y1 by assumption 9, more or less. And assumption 9 should be stated in a clearer way, which will be done for next week. That is to say, replace large number of homogeneous units, I mean same distribution, by a large number of homogeneous units or no unit with the same order of magnitude. Okay, but still, this definition doesn't work for what we call large risk. Because, for instance, if you think of insuring tankers, satellites, large factories with huge risks, such as chemical factories, okay, or nuclear plants, passenger planes, or whatever, this definition of insurable risk doesn't work. Because either you don't have a large number of them. For instance, if you think of passenger planes is a good example on the one hand, because either you think of any passenger plane, I mean from the twin-seater, which someone rents to go from, you know, in order not to take the train or whatever, and here the insured value is very low because the value of the plane and the value of the two people sitting in the plane is not that large. But you cannot tell this in the same insurance, in the same group as very large insurance claims, such as, for instance, an A380 or a 777, where there are more than 500 passengers. And moreover, that kind of planes flies over inhabited areas, so in case of crash, there can be damage on the ground, which amount to sometimes more than the value of the plane and the passenger themselves, etc. So, when you think of plane insurance, you can think that there is a large enough number of planes, but when you take together small and large planes, but what the Lindeberg condition says is that basically it's not the same group. So if you take on one hand the small planes and on the other hand the very large planes, then you don't have enough planes to use the central limit theorem easily. Or if you think about nuclear plants, for instance, well, nuclear damage is so large when you think of either Fukushima, as you have seen it, or a catastrophe, or even worse, the Chernobyl disaster. If you think of the Chernobyl disaster, no insurance company could pay for this because the losses were so large that clearly the insurance company would have gone bankrupt. So basically, the insurance of nuclear risk is the subject of an international treaty which basically says, in case of nuclear accident, please go with the state, with your own government, and things will be done there, but not by ordinary insurance company. Which doesn't mean that insurance has no role to play, but basically this has to be mitigated by the state. So all those kind of risks are so large that either you can go bankrupt with them or you cannot use the central limit theorem, but still you can insure them. So shall we write some special assumptions or now in fact there will be a little twist. In case of large risk, we must of course abandon the assumption 1, assumption 9. That is to say, of course, large risks are not in large numbers and are not disproportionate. But what we can in fact make them assurable by looking at assumption 8, just in the way I told you when I was talking about natural catastrophe and the way the state could put in place a buffer fund so that insurers do not go bankrupt. So with a clever or proper institutional setup, then you can transform a risk that could not be insured because the largest loss would make any insurer bankrupt into a risk that can be insured. But this is basically something that the market cannot do. So this must be organized by government for political reasons. Okay? This is politically motivated. And for instance, well, at the beginning of the pandemics, there was a controversy whether the state should or not organize pandemic insurance. Then the controversy moved to another area, especially in France, because as you probably have seen, there was a controversy whether the insurer should pay or not for operational losses of the businesses, because some businesses, they subscribed operational losses insurance, une assurance perte d'exploitation. And then the insurer said, we cannot pay because usually operational loss insurance is related to damage, not to economic conditions. Then some businesses filed a complaint against the insurer. Some of them lost, but some, in fact, they had a victory, a success with the justice, because not all the contracts were written in the same way. This is to say that maybe there is no need to look at the state. Maybe, according to the way the contract is written, pandemic insurance, or at least insurance against some consequences of the pandemic, is bearable for the insurance company. For instance, if the insurance company pays a fixed amount in case of some event. For instance, when gross national product is down by 5% in a given year, then the insurance company pays a fixed sum which depends on the contract and on the premium. That could be done without making the insurers bankrupt, because there is no potential ruin of this in this, because this could be priced, the probability could be computed. The point is, when the potential amount has no limit, then the insurer could go bankrupt, and then in order to make this risk insurable, there must be a proper institutional design, usually relying on the guarantee of the state. That's enough for this. Now, I would like to insist, when we look at this definition of insurable risk, I would like to insist that there are two difficult problems in insurance which people usually overlook. And this is a problem which is typical of people who are trained with statistics. Because when you're trained with statistics, you think that basically probability do exist. And it's quite easy to disclose them. And then, most often, random variables are independent. By most often, I mean, at least you can say, okay, those variables are independent and that's it. And in fact, most insurance failures come from the ignorance that both probability and independence are not things which are given by nature. Or shall I say, random variables are not natural beings, that go in the wild with a little sticker saying, okay, this is the probability distribution and I'm independent. It doesn't exist. And when you look at the beginning of insurance, hence I'll give you some historical example, it's quite clear to see that the failure of insurance is usually linked to the non-randomness, which is, or to independence problem, or to the estimation of probability, the proper estimation of probability in case of dependence, statistical dependence or moral hazard. So, you shall never assume easily that random variables are independent. Example 1. Okay, so as you know, central limit theorem works very well when random variables are independent. So let's take almost the same example as last week so that the computation will be easy, okay? And that will give us an example of what insurance companies usually do, okay? So let's consider life insurance. By life insurance, I mean insurance in case of death, okay? So consider a life insurance company that sells policy, and those policy, they pay 10,000 euros when someone dies. Of course, the 10,000 euros are not paid to the guy who dies because it would not make sense. but to someone who has been designated. Okay? Now, imagine the company has sold 10,000 contracts, and there's a 1% mortality. That means 1% of the policyholder do die every year, and 1 year is the term of contract. So the expected mortality is 1%, and so there should be on average 100 people, 100 policyholders deceasing during the contract. Because this is probability time number of insured, okay, or P time N, because we're talking about a binomial variable. Now, if we look at variance, then the variance, as you remember, the variance in the case of a binomial is P1 minus Pn, okay? So we have to multiply the expectation by 1 minus 1%, that is to say 99%. So we end up with a variance of 99, and let's assume that 99 is almost 10 squared. Okay, so that for a to make the computation simple, we'll say that the square root, the standard error, the square root of the variance is 10. So, and when we want to a confidence interval, I mean a unilateral confidence interval of the number of people dying in a given year, the 95% quantile of the standard normal distribution is 1.65. So there is 95% probability that we have less than 1 than expectation plus 1 standard error, 0.65 deceased person during a given year. 1.65 standard error means 16.50, 16.5, and of course, or 16.5, and of course there are no half deceased persons, so we have to take an integral dead so that we're sure that we have a 95% confidence level. Okay, so there is 95% chance that less than 117 person will die during a given year. That is to say, if we charge people 117% of the pure premium of the expectation, okay, then there will be 95% probability that you can pay for the claims, right? If we want a higher level of confidence, then all we have to do is take a larger quantile of the standard normal distribution. For instance, if we want to be 99.9% certain that we will pay for the losses, then we take the 99.9% quantile of the standard normal distribution. That is 3.09. That will lead to 31 dead above the expectation, okay, because it's 3.09 multiplied by the standard deviation, which is square root of 99. So it's a bit more than 3. So we have to, it's a bit more than 3 multiplied by 10, so we have to take a bit more than 30 overall, so 31 will be okay. And the result of all this is that, thanks to the central limit theorem, because of course, just figure out what shall we do if we don't have the central limit theorem. We should, of course, compute with the binomial distribution, and this will be a hell, because there is no cumulative distribution function, il n'y a pas de fonction de répartition for the binomial, so we have to try to compute the probability of every event, so a mess. While with the central limit theorem, from a calculation point of view, the calculation is quite easy. We want a given level of confidence, we compute the premium. Because when we want a given level of confidence, we can compute the number of people who die in the overall population, and we deduce the amount which should be paid as a premium, so that we get that number of dead people and that level of confidence. Fine. Now, when the central limit theorem doesn't hold anymore, what can we do? Let's take an example, okay? Let's assume that there is a chance of an epidemic. And for instance, there is a 1% chance every year that an epidemic breaks in. In case there's an epidemic, then the mortality rate rises to 10%. Well, in order to keep the same 1% average mortality, we have to compute the mortality which happens in every year when there is no epidemic. Okay? Because as the probability of dying rises when there is an epidemic, in order to keep the same average mortality rate, we must adjust the mortality rate when there are no epidemics. For this, we use the law of total probability. By law of total probability, I mean la formule des probabilités totales. So to make it clear, I had a small animation so that you get it. But at the moment, it's not very much animated. Okay. So, for instance, not for instance, but for the sake of calculation, take the epidemic. Okay, there is a 1% chance that there is an epidemic. So, on the other hand, there is a 99% chance that there is no epidemic, right? Now, when there is an epidemic, the probability of survival is 90%. And the probability of dying, of course, is the complementary, so it's 90 minus 1 minus 90, that is to say 10%. So the question is, what would be the probability of dying when there is no epidemic? In order to compute that probability of dying, you use the law of total probability, such that the total probability of dying, which is 1%, and this is the right-hand side of this equation, is obtained as the compound expectation of case of epidemic, 1% probability, 10% of dying, and then the case when there is no epidemic, 99% probability of no epidemic, multiplied by the probability of dying when there is no epidemic. So the probability of dying when there is no epidemic is obtained by, if you replace 0.909 by alpha, for instance, of course, you can solve this equation in order to obtain that alpha. This is the way I obtain the alpha. And so, in the converse, with the complementary probability, which is 99.091% or 0.909909, etc., you survive. So the overall probability of surviving is 1% case of epidemic multiplied by 90% plus 99% no epidemic multiplied by 99, 909, 909, etc. And in the end, the total probability of surviving is 99%. So once we have this, what we can do is compare this situation to the situation we just reviewed. Because overall, you see, the probability of dying is the same, 1%. But in this case, when we are looking for the 99.9 confidence level, the 99.9 confidence level involves the epidemic. And that is to say, the 99.9 confidence level clearly is when the epidemics happen and when a quite serious epidemics happen, because the epidemic has 1% chance of happening. So if you go to the 99.9 quantile, you have one of the 1 in 10 worst epidemics. So I omit the computation of the total number of deaths, which happens with, you see, 99.9% confidence level in case of epidemics, but this is above 1,000 deaths. And so, albeit the calculation is omitted, what is important in this respect is simply the result. The result is, when you have independence, you can use the central limit theorem to compute that there is a 1 in 1,000 chance that you have more than 31 dead above the expected number of dead. Okay? So the premium you may charge to be 99.9% sure to pay for the claims is only 131% of the mathematical expectation. That is to say, with a small charge, which is small charge, which we will call a loading. Okay, the loading is the premium minus the expected losses divided by the expected loss. Okay, or it's the premium divided by the expected loss minus 1. So, in case the central limit theorem works because there is independence among dying people, then a 30% loading will give you a 99.9% chance of being able to pay back for the claims. While, in case independents do not hold, you may have so many dead people that the loading factor should be basically 10 times. And in this case, it starts becoming quite difficult to ask people to pay that amount. That is to say 10%, while there is only a 1% chance of dying, because probably nobody would take the insurance in case you ask for 10 times the expectation. And moreover, nobody would do this simply because people would think, what is he doing? He's taking 10 times the price from me. That is to say, he has a profit which is 9 times what I'm paying. Well, 90% of what I'm paying is profit. So on the one hand, the prospect would be correct, reasoning like this. But on the other hand, it's true that if you want to guarantee being able to pay for the claims, then you must take that huge amount. So basically, that kind of randomness doesn't seem appropriate for insuring. It doesn't make economic sense. Okay? So we are under the assumption, or the assumption that there is an actual business model doesn't make sense in this case because of the absence of independence. Okay? So in case there is no independence, usually insurance is simply not possible. So maybe you think this example is maybe you think this example is not interesting or is maybe limited to epidemic problem, but in fact epidemic is a metaphor for any phenomenon which involves the loss of no independence between risks. Because basically what means independence, oh nice, what means independence? Independence means that the probability of a loss with a policyholder does not depend on the realization of the loss with another policyholder. Shall I say? So in case of epidemic, I mean epidemic of disease as we have, if your neighbor is ill, so if your neighbor has the risk, then the probability that you do have the risk as well, or that you will be ill as well, is higher. That's why we are all wearing masks, of course. Not in order not to transmit the virus to our neighbors. Okay? So this is what is incompatible with insurance, because if the probability of the risk changes with your environment, then, as we have seen, the risk may run to a very high level. Okay? And when you look, for instance, at the subprime crisis, then the subprime crisis is no different from the epidemic that we have seen. Because what happened with the subprime crisis? It happened that banks lent to people who were called subprime borrowers. By subprime, it meant that they were below prime borrowers, and prime borrowers are the borrowers that are supposed to pay back quite easily for their loans. So those subprime borrowers, the possibility for them to pay back for their loan was linked to the business cycle. As long as the business cycle, and especially as long as the housing cycle was rising, they were able to sell back their real estate and buy another one, or at least sell back their real estate and pay for the loan, take a new loan, buy a new house, and then sell the house, pay back for the loan and get a new loan, etc. But once the housing market collapsed, all of those guys became bankrupt. So it's more or less the same thing as an epidemic. Okay? It's a financial epidemic in some respect. Instead of getting sick, people got bankrupt. But for the sake of those who insured the payback of the loans, this was exactly the same as for the life insurers in our first example. What happened is basically that the insurance premium, which were priced in good times, that is to say before the collapse or the burst of the housing bubble, the insurance premium which were computed in peaceful times were okay. But as long as when the housing market collapsed, when the housing bubble burst, many guys defaulted at the same time, exactly in the same case as when the epidemic broke in, the mortality was far above the normal mortality, okay? So what is interesting here is that you see that in case of epidemic, it is quite obvious that epidemic means no independence, okay? While in case of what happens with finance, the point is it may be difficult before the crisis to figure out how people will be interlinked or what the spillover effects of a given bankruptcy will be. But basically, we see that when there is statistical dependence, the computation that have been made under the assumption of independence, when there is dependence, the computation which have been made under the assumption of independence, they do no longer work. And the problem is simply that independence is not a visible feature, or statistical dependence is not a visible feature of policyholders. So you have to be extremely careful about what you assume to be independent, or you will go through the next financial crisis. And unfortunately, you will be the heart of the crisis. That is to say, you will be bankrupt. So independence is something to look at very carefully. Now, another problem with insurability is that it's not given by nature. That is to say, you have to build or to assert or to secure the probability for your business model to be robust. So let's take two historical examples. Okay, the first one is probably the most obvious. That is to say that when we think of insurance, we think of probability calculus. Okay, we think of probability of loss and computing an expectation so that the premium is more or less the expectation plus some loading factor. Okay, but when we talk about the history of insurance, we told that the first development of insurance was marine insurance, or, well, even if marine insurance existed with land caravans in Mesopotamia in the 18th century before Christ, etc. But basically, insurance far predated probability calculus. So what happened? It happened, in fact, that merchants, before the French Revolution, they counted in fractions, okay? They reasoned in terms of fractions, simply because every currency was divided into shillings and then into pence, okay? I remind you that, well, or maybe shall I say this as a question? Do you remember up to what year was the British pound divided in shillings and pence? In 20 shillings of 12 pence each? Shall I say 1972? That is to say, just before the United Kingdom entered the European Union. And that was not part of Brexit. Nobody in Britain asked for going back to the system where the pound was divided into 20 shillings of 12 pence each. But remember, that was the case for the French livre, the livre tournois as well. Until the French Revolution, the livre tournois was divided into 20 sous, and each sou was divided into 12 deniers. Because this, in fact, we inherited this from the Romans. Okay, the golden currency was divided into 20 silver currencies, which were in their turn divided into 12 smaller pieces of currency, which were copper pieces. Okay, so there was no need for people to invent the probability calculus, because they were always thinking in terms of 1/240th of a currency unit. So they were somewhat naturally probabilistic. Okay? And they could easily think that the probability for a ship, well, in fact, when I consider one sea route, for instance, from Venice to Alexandria in Egypt, think of this, for instance, out of 10 ships that go to Alexandria, 9 come back. So you don't have to think in terms of probability with this kind of fractions of proportions, okay? Well, now when we look at the history of marine insurance, there was almost no technological change between Athens and the 19th century. And the only major technological change in the history of marine insurance was not about probabilistic computation, okay? It was mostly about ship certification by the Bureau Veritas, you know, who still exists, but who was founded in Antwerp in 1820. And the point with the Bureau Veritas is only to control the status of the ship, the maintenance of the ship, so that the expert who is in charge of controlling the ship may tell you the probability of this ship having a problem is 2%. So that the main technological progress in marine insurance was not about complex computation or whatever. It was only about ascertaining the probability by giving you some confidence estimate of the state of a ship. But the question is, how was it possible that before probability calculus and before Bureau Veritas, people engaged into maritime insurance? Because today, if we think of this, would you insure a boat today? Would you do this? I won't do this. I would not be doing this, of course, because I have no idea of the probability of the ship having a problem. Okay. But before we answer this question, another one, because in fact the answer will be almost the same. If you look at fire insurance, the early history of fire insurance, everybody will tell you, okay, fire insurance started in Britain, especially in London, because there was this great fire in London in 1666. You probably all have heard about the Great Fire of London for one very simple reason, which is that all the heart of the city was burned down, and it was rebuilt. And for instance, the current St. Paul's Cathedral was built right after the fire, and it was the symbol of the rebuilding of London. So it was far larger than the previous cathedral that was burned down. Okay, and the district around the St. Paul Cathedral, including the Bank of England, the Lloyds, etc., has been rebuilt after the fire. So it is said that fire insurance originated into the Great Fire of London because right after the fire, people were okay to pay for fire insurance. But what was fire insurance in that time? Today, fire insurance is basically, it's what we call property casualty insurance. You pay a premium, and in case a fire breaks in and does some damage to your property, the insurance company will pay you for the losses, okay? An amount which is in proportion with what has been damaged. Of course, the fire insurance company could require you to install some devices in order to control fire, such as sprinklers and fire alarms, etc. But this is part of controlling the risk. Okay? But basically, today, the fire insurance pays for the damage, for the losses. In that time, it was not the case. In that time, you could pay the fire insurance company, and the fire insurance company would, with that money, they would hire people to buy and maintain a fire pump that was supposed to pump water in the Thames River. So in case of fire, the pump could be used to put the fire off. Hence the name, of course, la raison pour laquelle les pompiers s'appellent des pompiers, c'est parce que c'est eux qui ont la pompe à feu, d'accord? Pas la pompe à eau. So the fire insurance company at that time paid for pumps and people armed with fire brigades, I mean with shovels, and those shovels should be, and picks, and they should be used to bring down houses so that in case of fire, you can create voids around the fire and avoid the propagation of fire, okay? So this is what I defined last week as assistance, not insurance, because it's supposed to provide a service, not to pay for the loss incurred. The reason is, why not compensate homeowners, as we do know in that time? And the reason, of course, is the same in both examples. The reason is what we could call moral hazard. I mean, in London, if you compensated the owner of burnt houses, then probably there would have been many insurance frauds with people setting fire to their own houses in order to get the insurance. Because in that time, insurers were not used to giving an expert opinion on the price of a house, and it was very difficult to control concretely the value of a house and of what was in a house, because most people, most businessmen, they stored their business merchandise at home. So it was very difficult to assess what was actually burnt, because there were no techniques relating to the expertise of what happened during a fire. So for this reason, of course, it was quite easy it would have been quite easy to make a fraud out of an insurance that would have paid back the value of the house itself. Hence, such an insurance scheme would have been self-defeating. And in case of marine insurance, but maybe let's finish with fire insurance. So the good thing is that if you pay for firefighting services, that is to say, de l'assistance, comme on l'a dit, but this is more preventing the risk of fire, okay? You avoid the realization of the risk, and this is good, because instead of incentivizing behaviors that lead to the realization of risk, what would have happened if the fire insurance company would have paid for the losses, then by spending the money of the premium into prevention against fire, into firefighting, then of course you fight the realization of risk and your business model is not self-defeating. Okay? There are traces of that, the way insurance was done. When you see those fire marks, today in Paris or in London you would not see any more fire marks simply because they are collectibles, and many insurance brokers or insurance employees have bought all the fire marks which were available in Britain or in France. But you can find many of them in Madrid, for instance, in Spain. You will see many times over the entrance over the door of a building, asegurado por el Fénix o bien el Sol o qué sé. And the point with fire marks is simply that the landlord said that he had paid the insurance, hence there were firefighters which were ready to intervene in case of fire. So this was a marketing argument for the house. Okay. Now, when we look at marine insurance, there was the same problem exactly from the beginning. We know that there was the same problem simply because one of Demosthenes' most famous pieces, Demosthenes is a Greek writer of the 5th century before Christ, and he wrote a piece which was called Against Phormion, and that guy Phormion is simply an insurance fraud. He committed the first documented insurance fraud. How? In fact, he borrowed money from Demosthenes in order to organize a shipment of whatever goods to the Black Sea. And he could not sell his goods. He could not sell well his goods because he was not a good merchant. So the operation was not profitable. So when he came back, he said that he was taken into a storm and he was forced to overthrow all the merchandise so that he do not have to pay back to Phormion. Because as you remember, this kind of bottom real loan, in that kind of bottom real loan, you borrow the money, but you pay back on the condition that your operations were profitable. So in case there is a storm, you don't have to pay back. So it's a kind of insurance contract, albeit not in the way we do it, where you only pay a premium and then the insurance company compensates for the loss, but you get the money first and you pay back when you're back from a safe expedition. Okay? So Phormion said he encountered the storm. Well, it was not the case. So it was an insurance fraud. And the history with Demosthenes is that, because the greatest thing with all this is that in the end Phormion sued Demosthenes saying, "You're a liar." Okay? So Phormion was a kind of Donald Trump, Basically, he never pays his debts, plus he sues the lenders, saying that they are fraud in sending, broadcasting fake news. That's funny because it reminds us that there are some, very constant traits in economic behavior, which is basically that self-interest may lead to fraud. Okay. So the point here is that we see that in order to correctly insure, insurer must control moral hazard. And how did Demosthenes manage to control that moral hazard? Or shall I say, how did the insurers for centuries and even millennia manage to control moral hazard? Simply because they had some informants in the ports when the ships go. And the way Demosthenes eventually won the trial against Phormio is simply that he brought from the Black Sea some merchants who said, I have seen that guy, Phormio. In fact, he could not sell his merchandise because he's a bad seller. So there was no storm. His boat was not taken into a storm. He's a fraud. He's just a bad merchant, just as, the orange guy. And in the end, Demosthenes won. But the point is that he won because he was able to control moral hazard. I'm not sure eventually the operation, bless you, was profitable, but because the problem is controlling moral hazard could be costly. But in this case, it was quite clear that insurance is only possible if you can control moral hazard. What do we mean by this? Okay, say that moral hazard is the possibility that the protected agent, I mean the agent who has signed an insurance contract, a protected agent who is at risk behaves differently from what he would do if he were exposed to the risk. Because it is, of course, obvious that Phormio would not have done the same if he had not the protection of Demosthenes' loan. Okay? Probably he would not have undertaken the expedition into the Black Sea because he would have thought that he may lose the money. Okay? And the same applies. People in London would be more cautious if there were no available insurance. Or shall I say, they would not set their own house alight in order to get the insurance money. Okay? So, and by the way, when we say moral hazard, it has nothing to do with morality. It's not a hazard of morality. By moral, we mean, the difference between moral and physical. Moral is what is referred to the behavior, to the decision, to the mind. Okay? So when we say there is a moral hazard, the difference is from a physical, or shall I say natural hazard. There are natural hazards linked to the weather, or to, when you're driving your own car, someone crashes his own into you. It's somewhat natural because it does not depend on you. But what is a moral hazard is what does depend on you. So in some kind, of course, in some kind of case, it's completely immoral when there is fraud. But in some other cases, the problem is not about immorality. It's simply that people become neglectful when they know they are insured. They do not take the same care about things. Some people buy a phone insurance, then they no longer bother about their phone, saying, "Oh, I'm insured." And when the phone breaks down, they just discover that the insurance contract is written in such a way that they cannot get the money. Okay, but so they have been neglectful because they thought they were insured. So that's the point with moral hazard. In order to make an insurance business profitable, you must control moral hazard. What happened? Yeah?
Can we buy insurance for an object or something that is liable if price fluctuation? For example, if I buy a house, I can insure my house, but if the price of the house goes really, really low, I can claim insurance, or destroy the house and claim insurance, and it will be more than the house.
If you destroy your house and ask for the house money, this looks very much like an insurance fraud.
Yeah, but we can say that or if I bought the house, for example, because the price value went low.
Yeah, so I see, okay, you want to insure against price fluctuations.
Well, the problem is that usually you want to insure against price fluctuation when price fluctuations are wild. Okay, so when the prices, the volatility of prices is really high, in which case it will be difficult to insure. Because, look, the point is simply that usually what makes a risk insurable is the idea of mutuality. That is to say, think about the definition of the Lloyds, you know, the contribution of the many to the infortunes of the few. That is to say, the basic of insurance is that not all insured are victims of the risk at the same moment. While if the risk is epidemic, and that might be the case because fall in house price may be linked with the housing cycle, in which case basically it's an epidemic and you cannot insure against an epidemic, you see. But still there are some cases, for instance, crop insurance, I mean the insurance of agricultural harvest, okay, agricultural staples. There are crop insurance schemes. And in fact, crop insurance schemes have been substituted mainly for, you know, the ancient way the government managed insurance crop prices. You probably remember that until the 1990s in Europe, but it was also true for the US until the 1960s, the government decided the prices of staples. For instance, one bushel of wheat was worth 200 euros, and the government, I mean the European Union, was buying the staples at that price. The problem is that this didn't work because the quantities increased, and at some point the European Union was not able to pay for all the staples. So we turned to another schemes where now the national governments are responsible to develop insurance schemes to insure the prices for selling at which the crops can be sold, or shall I say. The farmers can buy crop insurance. But so far I haven't seen any crop insurance schemes being profitable. That is to say, every crop insurance should be subsidized for this very reason, which is that this is somewhat epidemic, because when the price of a crop goes down, then everybody has the problem. So when you have that kind of problem, it's no longer insurance. You know, the term is not exactly insurance. You have to do it's about politics, but because it's about distributing the losses among the population. And well, in some countries, people could not, well, or decision makers or the people itself would think that it is not acceptable for 10% of the population, perhaps, to lose all his wealth. So something should be done in order to mitigate that collective risk. Well, in some other countries, people do not care and say, they are losers and so bad for them. But of course, usually insurance cannot be designed for that kind of insurance, except when there is a state guarantee, which means political will to do this.
But to counter that, can we put together different sectors for different maybe crops in that case? For example, if wheat is low, can we pull it with, I don't know, corn, so that
yeah.
Maybe, I mean, the markets maybe are dependent, I know, but maybe it's something that only affects one sector.
No, you're right. From the point of view of the mind, the idea is whether we can diversify or not that kind of risk. My point is that, and when I see the insurance sector, that kind of risk, it's more or less what I've been telling about, you know, operational losses insurance since the beginning of the pandemic. Insurers are extremely reluctant to sell guarantees that are linked to the macroeconomic cycle, because the macroeconomic cycle is more or less homogeneous all over the earth, so it's very difficult to diversify out first. Then the point could be that for some kind of risk, which are not linked to the macroeconomic cycle, what you could do is provide some insurance, but especially if the amount which is insured is not linked to the amount of damage, but is a kind of, you know, it's a fixed sum. For instance, you insure your crops in case there is not enough rain, but you won't get an amount which is in relation to the severity of the drought. Okay, you will get a fixed sum. That is to say, you will get 100,000 euro in case there is the amount of rain is this, and that's it. Because in fact, if the amount of money you can get could be twisted, it could lead to fraud. So the problem is that moral hazard is very difficult to define and to control. In some cases, okay, and insurance fraud has been a fantasy for many people. You know, okay, let's say I'm insuring a Porsche, whatever, a very rare Porsche, and in fact I burned a Renault or a Citroën, and I get the money. Of course, the expert will come and say, no, it's not the regular car. But many people will try to, you know, insure a very expensive good and expand not that expensive good in order to get the money. That basically that's what you should control. But of course, the idea is that when the risk is not, you know, when the risk is widespread, when the risk is somewhat epidemic, you cannot insure. So the takeaway from this historical example is simply that risk needs to be controlled to ensure that the probability of disaster is as you predicted. It stays as you thought before you sold the insurance it was. Okay. This is just to say that insurance statistics are not given by nature. In fact, they are produced by controlling moral hazard. Okay. And so insurers should produce behaviors that generate reliable probabilities. And when I say this, it means, for instance, when you go for a fire insurance, then, well, of course, when you're a natural person, comme vous êtes une personne physique, when you go for a fire insurance, if you have a 3-room flat, then the insurer won't go visit your apartment, okay? Because basically there are regulations which say there should be a smoke detector and that's all. But if you go for a fire insurance and have a large house, or if you want to insure a plant or whatever, then the insurer will come and see whether your house is fine. And if not, he will say, you need sprinklers, you need fire detectors, you need whatever, you need a remote alarm, etc. So this is controlling moral hazard because this will be written in the contract. And if those devices do not work for any reason, then the insurance will be void. And in fact, by controlling the development of the risk, the insurer is, of course, providing a service, which is he will pay back in case of, but he also provides a service of expertise, which is controlling for the risk. And when you think of what the insurers do today, for instance, if you look at car safety vastly improved over the world since the 1970s. You probably remember that in the early 1970s in France, 17,000 people every year died on the roads, you know, in car crashes. Now it's somewhere between 3,000 and 4,000, while people use their car 10 times as much. Okay? Simply because many more people who have car and they use their car much more than they did in the 1970s. That is to say, with 10 times the amount of kilometers driven every year, there are 6 times less people dying. The reason is, of course, that the car safety and road safety has been enhanced. But the driving force behind this was the insurers, because they passed law. They lobbied in order to pass law, to make safety belts compulsory, to make yearly inspection of vehicles every 2 years compulsory, to ask the government to make the road better, etc. So in the end, the mortality rate on the road is 60 times less. Okay. So controlling for probability of risk, controlling for moral hazard. That's number one. And number two, this is a way of introducing life annuities. You see. So the first guy to provide a life table was John Grant. Okay, and his book was published in 1662, and his life table was really very coarse, because this is the life table in Grant. So you see, there are 100 people born in year 0, and after 6 years, 36 of them died, so there are only 64 survivors. After 16 years, 60 of them died, so there are only 40 survivors. After 26 years, 75 of them died, etc. So, Lebras has shown that this life table has nothing to do with actual statistics. Okay, it is not. It has nothing to do with real people dying. In fact, it was only you can obtain it basically by multiplying every figure on the top row by 60%. Okay. So the mortality rate from one period to another is not 60 but 36%. Sorry, but whatever. The point is that when you look at mortality, or shall I say better, survival table, because this is the table of the number of survivors at a given age. When you look at a survival table, you think it's natural data. It comes from nature, because nobody can alter life. Okay? Nothing seems more natural than life, especially in that time when there was no medicine, and so no modern medicine, so life could not be altered. But now, when you think about using that table to price insurance, then you should be careful. Because, for instance, we all know that men and women do not have the same life expectation. Hence, they do not have the same mortality as well. And, in fact, the first tables which separated men from women dates back not from 1662, but from 1740. They were invented by Willem Kersenboom, who was a Dutch actuary. And do you have any idea of when life annuities have started to be sold at their actuarial prices? Well, by actuarial prices, I mean in order to correctly price a life annuity, hence a contract that pays you one currency unit every year until you die, as long as you're living, okay, you must first get a mortality table and then assume a discount rate. And basically the value, the price of a life annuity is the probability to survive, and you discount the future payments. Okay, so you must have both the survival table from your age until the exhaustion of life in humanity on the one hand, and then you must discount the future payments. So let's call Lx the number of survivors after X year in the survival table, and you'll see quickly that the life annuity is given. Okay, the price of a life annuity is given, in fact, by the sequence of Lx divided by L0 and discounted for X years. Okay. This is life annuity, so this is life insurance in case of survival. Well, if we're interested in life insurance in case of death, then of course the probability of dying is given by Lx minus Lx plus 1 divided by Lx. I remind you that Lx is the number of survivors now. Okay, so number of survivors now minus number of survivors 1 year from now, it means the number of people who will die during 1 year, divided by the number of survivors and the population now. Okay, so this will give you the probability of dying. Well, first, the first actual computation of life annuities were done by Edmond Halley, the guy who saw the comet in the sky. Okay, because he recorded birth and death, so that he could compute a real experience-based survival table. You see, there is 1,000 persons living at 1 year. At 2 years, there are only 855. At 3 years, there are only 798. At 4 years, 760, etc. Until in the end, yes, at 84 years, there are only 20% remaining. Okay, So doing so, he can then compute an expected age of death for those who die, and then compute the average life, that is to say, the life expectancy. Okay? But the point is that there are many different mortality tables. If you look at those who wrote after Halley, there were many mortality tables. Why do we see so many mortality tables? Because life was not the same in every country in Europe. Life was not the same in every social class, etc. But also because, in fact, not every people do have the same life. So now, if we think of the two main risks when we are talking about selling life insurance, if you're selling life annuity, you don't have any problem with suicidal people, because of course suicidal people do not buy life annuity. That is to say, you should remove these from the survival table, because if you're selling life annuity, you know that suicidal people will not buy those life annuities. So you should have a survival table which is clean from those who do not want to buy life annuities, and not just suicidal people, but people who drink too much. Probably they won't be buying life annuities because they know that they are at risk, etc. But the problem with suicidal people is that they might be tempted to buy life insurance in case of death. Okay, so that is to say, death insurance, in order to well, as a gift for someone they love. You see. So, in fact, a survival table of annuitants, I mean of people who buy life annuities, is required to correctly assess life annuities on the one hand, and a survival table of depressives, or of people who intend to kill themselves, should be needed to assess life insurance, I mean, to assess the minimum probability of dying. Okay? Well, maybe the second one is a joke, but because you can, of course, control for suicidal by excluding suicide from insurance in case of death. But then you're not always sure that someone killed himself. So it's an issue. Now, if we look at the first condition, at the first question, that is to say, how could we try to build a life table or a survival table of people who buy life insurance? The survival table by Antoine de Parcieux was built exactly in this way, but for a very simple reason, which is that the French monarchy in the 1680s, the French monarchy issued some life annuities, and the archives kept the record of the ages where the annuities were paid, so that when de Parcieux came in 1746 and he was interested in computing the survival table which would be fit for pricing life annuities, he found this data. So he used this data. But the problem is still that he was in 1746, and the data dated back from the 1680s. So, maybe in that time, mortality did not change much. But now, if we think of using a mortality table 70 years in the past, things have changed because, because of the progress of medicine, because of the progress of safety. People live longer, so that if you want to sell life annuity, you cannot rely on the life data which are 70 years old. Okay. But in the end, the point I would like to make here is simply that in order to price correctly their contracts, what the insurer should do is that they should select their customers. Because, we can solve the life insurance problem by having proper mortality tables, but still, okay, we cannot consider the general mortality table for people who want to buy life annuities, because people who buy life annuities, they are free from condition. You would not buy a life annuity if you knew you had a pancreatic cancer, of course. So people who have pancreatic cancer should be removed from the survival table, etc. all people who have conditions that, in fact, forbid the buying of mortality table should be removed from the survival table that you use to price life annuities. That is selection. In the raw sense, you put them out of your random sample. Okay? And more generally, well, so if we go back to the problem with selling life annuity, and in order to solve this definitely, and then we'll try to generalize, the problem with selling life annuities during the 18th century was not the absence of survival tables. As we have shown, there were too many of them. Okay? The problem was, in fact, that tables were tables of the general population, not of life annuitants. And actuaries, I mean, the guy who made the probability computation for the insurance, they were not able to sort out, to select in the general mortality, in the general population, the subsample that was relevant to pricing their contracts. That is selection, okay? Selecting the data which is relative and which is relevant to correctly pricing your contract. So, of course, successful insurers of the time were those who were the best able to sort out that data mess, okay? But today's as well, the statistics are not given. Because if you look at mortality, you will have general mortality. But if you want to sell life insurance, you could not rely on general mortality. You must choose the right mortality. Hence, here again, the statistics, even the probability for the insurance contract, they are not given by nature. They are the product of the insurance action. So this is my important advice to conclude this historical part. Okay. In the following, we will write down probabilities as if we knew them. Okay. And in the following, we will do as if there is no moral hazard, no information asymmetry, etc. But in fact, it must be understood that this probability, they do not naturally appear. They are the product. Okay. We make this probability by selecting the insured. I mean, hence by selecting among the insurer those who are not fraudsters, and by selecting the data which is relevant to price correctly their risk. Okay, so we select the risks, then we control for moral hazard, and in the end, the probability, the actual probability, is consistent with the a priori probability which we computed. Okay, so from now we are going to talk and to think as if we knew the real probability distribution, but we must understand that inferring probability distribution from data is no simple feat. Okay. Now go ahead with talking about the organization of insurance, of the insurance sector. Because, well, now we have the basics. We understand that probability are not given and that there are many problems. But let's go to how the business is done. The first interesting thing is that if we look back only 5 years ago at the sector, then the sector had appeared globalized but massively European. Because 5 years ago, the largest insurance company in terms of turnover, okay, chiffre d'affaires, the largest insurance company in terms of turnover was Allianz, and then AXA, and then Generali. I mean, the Assicurazioni Generali is, of course, an Italian company from Trieste. And so the third largest insurance company were European. Then there was China Life, then American International Group, then Nippon Life, then Prudential, which was the first British company, then Zurich, then CNP, la Caisse Nationale de Prévoyance, okay, then Aviva. So among the 10 largest insurance companies, almost all continents were represented, except Africa. And well, there was only one American company, because Americans do have many subcritical companies, I mean, which are not in the 10 first, but are between the 10 and the 30th place, okay? Rank, I mean. Insurance appeared especially concentrated in Europe. If you look at the landscape right now, Berkshire Hathaway has merged many companies so that now it's the largest in terms of turnover. Then Ping Han is number 2. AXA went from rank 1 to rank, from rank 2 to rank 3. China Life is now in front of Allianz. Prudential has climbed some stairs, Aviva as well. Generally went down. Legal & General also appeared in the ranking, and the People's Insurance is Chinese as well. So now, only 5 years after the 2015 ranking, the Chinese insurers are ranking, 3 Chinese insurers are ranking in the top 10, as well as 3 British insurers. Hence, the share for continental Europe on the one hand and the US on the other hand appears quite small. The point is, the interesting point here is twofold. First, the insurance sector is very dynamic. And it's very dynamic for at least 2 reasons. One, there are really emerging countries, and actually, quite clearly, Asia is the most emerging area in the insurance business, with not just China. Because if you look at Prudential, albeit Prudential is a British-born company, in fact, Prudential completely changed its focus. Prudential was a British-centered insurance company, but when Tidiane Thiam became the CEO of Prudential back in 2006, as far as I remember, he decided to go on runoff in the British Isles. That is to say, he stopped signing any new contract in Great Britain because he thought the British market was not profitable. So he redeployed all his marketing strength and focus on Asia, from Dubai to Hong Kong. Well, I'm not sure Hong Kong was the best pick, but the point is, this strategic move was wholly successful because Prudential, who was thought to be really in trouble in the year 1990s, is now the most dynamic British insurer, and it illustrates the strong growth in the Asian area, shall I say, rather than Asian continent, because Asia is made of many isles as well. So, strong dynamic in some area, Latin America, Asia, strong dynamics in emerging countries, on the one hand. And on the other hand, the other interesting point is that the ranking of companies can change because companies are still in a process of concentration, very strong process of concentration. Of course, if you looked at the same ranking in the 1980s, it would have been completely different, because most of those groups did not even exist. Aviva, who is ranking number 2 in Britain, did not exist. Aviva was built out of Norwich Union. You probably know what Norwich Union is. No, probably don't know. Norwich Union was a mutual insurance. And by mutual insurance, I mean it was owned by its members. The point is that during the 1990s, when the interest rates were very low, were dropping, because they were not as low as they are, but they were falling, okay? And falling interest rates meant that since the liability side of Aviva, who was the life insurer, the value of the liability side was dropping quicker than the value of the asset side because of lowering interest rates. What Aviva, this created a virtual profit. And the idea among the owners of Aviva was that by turning from a mutual company into a limited company, okay, with shares, the owners of the mutual company could pocket that virtual profit. So this is why many Britain or Commonwealth or English-speaking country-based company demutualized during the 1990s and the year 2000 as well. It was not the case on continental Europe for a very simple reason, which is that in most cases in continental Europe, when you transform a mutual-owned company into a private-run company, you cannot take the profit with you. You must give the profit to a fund which is given to all the mutual companies. Well, it's the case in Italy, for instance, but in France, you can simply not take the profits. You must keep them in the company. So there was a quick drive to concentration since the 1980s, involving, as I've been telling you, demutualization, which was one of the big, things of the 1990s and the year 2000, involving cross-border mergers, which is, for instance, the case with AXA. AXA is a very good example because AXA, until 1985, AXA was called Les Mutuelles Unies. And AXA was a small mutual insurer, small French mutual insurer, when Claude Bébéar, the then boss of AXA, started consolidating the French insurance sector. Then he went abroad, and in order to go abroad, he knew that Mutuelles Unies was not a serious name to go abroad, because you cannot be Les Mutuelles Unies in Latin America or in China. It would be ludicrous, because nobody can correctly pronounce French. So he chose the new name exactly to expand abroad. And then, as you will see, AXA now is number 3 in terms of revenue in the world, but it's not even number 1 in France, because in France it's ranking beyond or below Crédit Agricole. Well, of course, at the world level, Crédit Agricole is nothing, because Crédit Agricole is strictly French. Okay? So there were large transnational mergers, and as now, if you put together those two interesting points, on the one hand, dynamic areas, and on the other hand, mergers, of course, the point is that, for instance, Latin America is still not very much consolidated, as well as is Asia. That is to say, there will be large growth in those countries, and probably larger and quicker than growth with banking. Okay? So things will happen in this sector. Now, if we look at the French sector, the interesting thing is that, well, it's more or less the same hierarchy as the world hierarchy. I mean, those big guys that you will see at the world level, you will see them as well in France. Maybe not Berkshire Hathaway, but Allianz, Generali, Aviva. Well, the British insurer, they do not have a very large market share in France. Plus, you have French-specific players, which are quite funny to look at. So let's, for instance, have a look at Covea and at AG2R La Mondiale. Well, in AG2R La Mondiale, the name is explicit. It's explicit that it's a SGAM. SGAM is a French specialty. It means Société de Groupe d'Assurance Mutuelle. Because we've been talking about concentration. It's quite obvious that AXA is the result of a very large concentration, right? It's quite obvious that Allianz as well is a result of a very large concentration move in Germany, and generally as well in Italy, etc. But when you think of the mutual insurance sector, there is no way you can do a concentration. You know? You cannot go on the stock market and buy your competitor, because it's a mutual insurance scheme, which means that the policyholder, they hold the insurance. So how do you proceed to concentrate mutual insurance? Well, strictly speaking, it's impossible. But the French government was aware that concentration was required in order to improve the competitiveness of the sector. So what the government did is that in the 1990s, a law was passed which allowed mutual insurance companies to team together in Société de Groupe d'Assurance Mutuelle, which basically is the relative of a holding company for a public limited company. I mean, for companies with shares. That is to say, the Société de Groupe d'Assurance Mutuelle are holding companies which can hold, or which can put together mutual companies so that the whole structure remains a mutual, while it's not a mutual in proper terms. Because the basic idea with the mutual is that since the policyholders own the company, they do elect the governance. Okay? But when you team together mutual company, you don't put together the governance. You keep the original governance, that is to say, people, they still vote in their small company, and you put on top a holding which is not just a financial holding, but which usually is also providing support services so that you can get some gains from teaming together those companies. Okay? There are some you can save on synergies and on economies of scale by having, for instance, the IT service which is externalized to the holding, to the SGAM. Okay? But this is a very complex move. Because still, if you stay with the governance of every business unit, it's quite cumbersome to reach any decision. You cannot radically overhaul the organization. You cannot shake the management, etc. But this is quite specific to France. I mean, this kind of structure is quite specific to France, and it's important because it's protected from concentration, because you cannot buy those GAM. So one of the specifics of the French sector is how concentration happens between mutual companies. Because as you see, there are, in this top 12, Covea is a mutual company, Groupama is a mutual company, Natixis is a mutual company, ACM, c'est les assurances du crédit mutuel, mutual company as well, and La Mondiale also. So almost 1 in 2 insurance companies are mutual company. Of course, they don't do 50% of the turnover because basically mutual insurers, they are focused on retail insurance, on insuring natural persons, not large risks and not large corporate exposures, okay, which are more a specialty of private insurers. But still, another interesting point that you see here is that while you see Allianz and Generali, there is not much openness in the insurance sector in Europe. I'm not saying that the sector is uncompetitive. I'm just saying that it's quite difficult for an insurance company to penetrate a foreign market, simply because insurance contracts are very different from one country to another. To take only one example, until 2016, there was no automatic renewal of the insurance contract in Great Britain. That is to say, you bought a 1-year car insurance, and after 1 year, the contract was over. And it was completely up to you to buy another one. But if you forgot to do this, then you would have been uninsured. Where in France, as you know, the contract is automatically rolled over for another year, unless you write 2 months in advance to your insurer, and you cannot write a simple letter. You must write a special letter, une lettre recommandée avec accusé de réception, to say, I quit the insurance, and then go to another insurer. That seems to be nothing, but it's a lot, because it has to do with business practice. And basically, the way the contract is written is completely different from one country to another. Because some clauses which are customary in one country are not in another one. So basically, when an insurer wants to expand into a new area, either he's very clever to set up a new business, or he buys another one. He buys a formerly existing business. That was the case with Allianz. Allianz was trying to get his foot into the French market, and he did not succeed much until he buys les Assurances Générales de France. Right after the privatization, okay, Allianz bought them, so that he bought a huge market share, and he transformed the Assurances Générales de France into Allianz. By the way, Allianz is one of the rares. SE means Société Européenne. I guess, in fact, the acronym means Societas Europea. It's a Latin acronym. So it means it's not a German company, it's a European company. And you know, there are some, you can create European companies for some statutes. They do not exist for mutuals. the interesting point with European companies is that it makes easier to merge companies from various parts of Europe into the same European company status. But why I say that in the end, penetration of the domestic market, oh my God, it's time, sorry. Why I say that the penetration of domestic insurance market by foreign insurer is weak is simply that you see Allianz, you see Generali, but the point is you see only number one. Do you have any idea of who is ranked number 2 in Germany? Who is the insurer ranked 2 in Germany, for instance? It's Talanx, but nobody knows them simply because they do expand outside of Europe, but not into Europe. For instance, there is no Spanish insurer, while MAPFRE is very important, but in fact, MAPFRE decided to focus more on Latin America. So my point here is that, albeit we have a very globalized market because we have very large players, the European market itself is not, well, it's somewhat open because large European insurers bought domestic insurer in many countries and they consolidated the sector in this way. But still, there are very strong national particularities and differences. And for this reason, of course, we will develop some abstract thought about, for instance, macroeconomic approach toward pricing insurance contract and peculiarities of the insurance contract. But in fact, every time you think of insurance, you have to think of insurance somewhere, in a given legal framework. Because, you know, the purely economic, I mean, microeconomic approach to insurance can be quite far away from the reality of the sector. Well, hence, in the following, we'll be talking mostly about trends, and it's not always relevant to think of other insurance markets, but it's difficult not to, choose a country to talk about. Well, now it's time. Thank you for your attention, and have a nice week.